In a palm oil plantation, there is a distinction between barrier plants and biological assets. According to MFRS 116, all palm trees are classified as barrier plants because they are used repeatedly to produce fresh fruit bunches or FFB over many years and are not intended for sale. In contrast, the FFB growing on the trees are classified as biological assets under MFRS 141 because they are agricultural produce that will eventually be harvested and sold. The measurement basis for each is different. All palm trees are measured at cost less accumulated depreciation and impairment loss under MFRS 116. Meanwhile, FFB are measured at fair value less cost to sale, with changes in fair value recognized in profit or loss under MFRS 141. This distinction is important because it provides a faithful representation of the company's financial position. The oil palm trees are long-term productive assets, while the FFB represent the current agricultural output. Using the appropriate accounting treatment ensures that assets and profits are reported accurately and fairly to investors and other stakeholders.
The CFO's valuation does not achieve faithful representation. First, it is not complete because it ignores biological risks such as weather, disease, and uncertain yield. Second, it is not natural because the CFO insists to report higher asset and profit to attract investors. Third, it is not free from error because immature FFB are valued using the market price of harvested FFB without any adjustment. Although both are biological assets under MFRS 141, immature FFB are still undergoing biological transformation. Therefore, a more faithful valuation should consider the maturity stage, biological risk, and measure the asset at fair value less cost to sell.
Okay, for part C, as a junior accountant, there are several ethical risks in complying with the CFO instruction. First, this is a branch integrity because using the full market price of harvest FFB may overstate the value of immature FFB, resulting in misleading financial information. So the second one is there is a lot of objectivity. The pressure the CFO may influence a professional judgment instead of complying with the accounting standard. So before raising concern, I should review MFRS 141 first and gather evidence to support why the evaluation method is inappropriate. After raising concern, if the issue is remain unsolved, I should escalate and the matter is a senior management or the audit committee and document all discussion and action will be taken. Finally, I have a professional obligation to external users of the financial statement. I must provide reliable information to the investor and the stakeholders and act in the public interest by ensuring a compliant with the accounting standard and ethical principle. Thank you.
Okay, in this section, I will explain the correct accounting classification for the three properties owned by Apex Holding Berhad. Property 1 is mixed-use building. The 7th floor leased to tenant are classified as IP under MFRS 140 because they generate rental income. Meanwhile, the 3rd floor used as the company headquarters are classified PPE under MFRS 116. Okay, next, property 2, which is land held for undetermined future use, is classified as IP under MFRS 140. And lastly, property 3 is being developed for sale, so it is classified as inventory under MFRS 102. Okay, next, the measurement basis depends on the classification of each property. Both property 1's investment portion and property 2 are initially measured at cost and subsequently measured using either their fair value model or the cost model under MFRS 140. The owner-occupied portion of property 1 is measured at cost and later under the cost model or revaluation model in accordance with MFRS 116. Property 3 as inventory is measured at cost initially and subsequently at the lower of cost and net realizable value under MFRS 102. Finally, the CFO proposal is incorrect because each property has a different purpose. Using the correct accounting standard ensure the financial statements are accurate and reliable. Thank you.
The accounting treatment for fresh taste food manufacturing Berhad according to MFRS 137. So first, for the product recall cost, the company should recognize a provision of 1 million. This is because the contamination has created a present obligation. the return of product is probable at 70% and the cost can be reliable estimated. Second, for the consumer lawsuit, the company should not recognize a provision. The legal advisor believes there is only 30% percentage chance that the company will lose the case. Since the outflow is not probable, it is treated as a contingent liability and only disclosed in a financial statement. In conclusion, under MFRS 137, uncertainty is very important if the outflow is probable and measurable, as a provision is recognized. If the obligation is only possible, it is disclosed as a contingent liability.